Orla Mining has evidently decided they no longer want to be a Mexico-focused single-asset producer. The gold miner this week entered into a transaction with Newmont, one of their major shareholders, to acquire the Musselwhite Gold Mine in Ontario for total upfront cash considerations of US $810 million. The purchase, slated to close early next year, is expected to launch Orla into the intermediate producer category, while dramatically altering their mining profile. All right, guys, we're talking mining. We are talking Orla Mining. We're talking a big transaction with Newmont. Let's dive in. All right, let's start off with the high level. Orla Mining has agreed to purchase the Musselwhite Gold Mine from Newmont, in a transaction that will see the miner pay $810 million in upfront consideration, plus an additional $40 million in contingent consideration. The purchase will add an estimated 200,000 ounces of annual gold production to Orla's portfolio, while enabling the miner to escape the title of being a single asset producer. On a combined basis, Orla will now have estimated annual production of about 325,000 ounces a year between their current Camino Rojo mine in Zacatecas, Mexico, and the Musselwhite complex, at an all-in sustaining cost of about $10.80 an ounce. Even more interesting, it sets the company on a path to 500,000 ounces of annual production once the Nevada-based South Railroad mine comes online, which is estimated to occur in 2027. The accretive purchase will add 1.5 million proven and probable ounces to Orla's reserves, while also adding 1.8 million measured and indicated ounces. Post-transaction, Orla will boast 4.3 million proven and probable gold ounces in reserve, a 53% improvement, while measured and indicated ounces will improve 15% to 15.3 million ounces. The transaction is slated to close in the first quarter of 2025, subject to shareholder and regulatory approvals. All right, so what is Musselwhite? Found on the shore of Opapamiskin Lake in northwestern Ontario as part of a 65,000 hectare land package, the Musselwhite mine is a fly-in, fly-out underground operation that originally went into production back in 1997. Over its 28-year history, the mine has produced about 6 million ounces of gold. A 43-101 technical report produced by Orla estimates the net present value of the project at $760 million based on 2150 gold and a 5% discount rate. That figure rises to $1 billion at $2,500 gold. The mine, with an estimated life of 7 years based on current reserves, is expected to produce 200,000 ounces of gold a year on average, at an average grade of 6.2 grams per ton, with an all-in sustaining cost of $12.69 an ounce. Mining rates are to average 1 million tons per year, while the mill has capacity for up to 1.5 million tons a year. Average annual free cash flow is estimated at $150 million over the next 5 years. On top of this, there is, of course, said to be significant opportunity for resource growth, because there always is with purchases like this, with mineralization remaining open at depth. Strong gold mineralization is said to have been intersected 1 kilometer beyond current reserves, and could extend more than 2 kilometers beyond current drilling. An exploration plan here is already in place, focusing on replenishing reserves and growing resources. All right, this is all well and good, but how does Orla plan to fund the purchase? Well, it's a bit messy, with the company pulling on a number of strings to get things in place. Let's break it down in a simple way. The total purchase price here is pegged at US $810 million, plus some contingent payments which are based on the price of gold. Here's how that $810 million is to be covered. First, they got $10 million that's going to come from existing cash on hand. Orla currently has about $145 million of cash on the balance sheet. $100 million will come from a term loan from a syndicate of lenders, including Scotiabank, Bank of Montreal, CIBC, and ING Capital, with a 3-year maturity and an interest rate of the secured overnight financing rate, plus a margin of between 2.5% and 3.75%. $150 million will come from an existing revolving credit facility, which is due August 2027. $200 million will come via senior unsecured notes led by Fairfax, Pierre Lassonde, and Trinity Capital Partners, who are cornerstone shareholders of Orla already. The notes are due in 2029, bearing interest at 4.5% per annum, convert at $7.90 per share, and contain warrants at $11.90 per share. And lastly, $350 million will come via a gold prepayment facility from the same syndicate of lenders funding the term loan and credit facility, minus Scotiabank. Approximately 150,000 ounces are expected to be delivered over 3 years to repay the facility, representing 16% of consolidated production. As for the contingent payments, Orla is to pay an additional $20 million in cash if the average price of spot gold exceeds $2,900 for the initial 1-year period following the closing of the transaction. Another $20 million is to be paid should the average gold price exceed $3,000 an ounce during that period. All right, as always, there's some problems with the transaction. The glaring issue here is the claimed all-in sustaining costs that the mine will achieve. And a hat tip here to Ben Kramer Miller, who highlighted this on Twitter. Quite simply, Musselwhite has come nowhere near the 1269 AISC that Orla is forecasting in the last 2 years. Since Q1 2023, the lowest AISC at the mine has been $13.97 an ounce, which was achieved in Q2 of 2024. The highest, meanwhile, was $22.54 an ounce, which was in Q2 of 2023. Orla's own production schedule, which was posted in a slide deck on the acquisition, basically shows how absurd the claim is as well. They suggest that 2024's AISC will fall from $15.57 to $12.92 next year, before sinking as low as $10.23 an ounce in 2028. The decline is attributed to growing production, while total capital costs get dramatically reduced. We'll see how realistic that actually is. As for the cash flow claims, 2024 cash flow is estimated at $68 million, which is to nearly double to $126 million next year, which is attributed to the costing claims. Again, we'll see. All right, so let's wrap it up. Did Orla pay too much for the asset? I'll let you be the judge on that one. Yes, it's based in a Tier 1 jurisdiction and it has a history of production. But costing estimates here seem unrealistic, which inherently impacts cash flow and the ultimate value of the asset. For what it's worth, independent valuations conducted by Scotiabank and Stifel and paid for by Orla's board suggest that the asset is worth between $910 million and $940 million. But it should also be noted that Newmont is a 13% shareholder of Orla, behind only Fairfax in terms of ownership stakes. That being said, paying a slight premium to no longer be a single asset producer may be worth it in the long run. And if those free cash flow projects actually work out, the cash could go a long way to developing the South Railroad project in Nevada with minimal dilution to equity holders. Now, I've made it very clear on my past videos that I think that now is the time to be aggressive if you think that this gold bull market is here to stay. Good assets aren't going to be around forever. Clearly, Newmont is freeing up cash to do bigger things, and that makes a lot of sense. And I applaud Orla for going out and getting this asset. Some of the assumptions that they're putting out there seem to be a bit aggressive, but I think that this is a quality asset, and I give them kudos for going out there and getting it. Guys, thank you for watching. If you enjoyed this video, please smash that like button, subscribe, and ring that notification bell. Folks, also let us know what stories you want us to cover in the comments section. We appreciate all the engagement we're getting, and we want to keep delivering for you guys who like investing in equities, often with a mining focus. That seems to be what people like to talk about on our channel lately, and we appreciate all that engagement we're getting. All right, everybody, thanks for watching.